Welcome back to Talk Tickers. This is your audio digest for the earnings calls that, actually matter. We strip away the PR gloss and get right to the numbers. I'm your host.
And I'm here to help you make sense of all the noise. And today, we are heading to Tokyo.
We're digging into Nomura Holdings, ticker NMR, if you're on the New York Stock Exchange, 8604 in Japan. This is for their third quarter fiscal year ending March 2026. And looking at the tape, it was not a good day.
It was red, very red.
Down about 4.6%. The ADR is sitting just under $9. If you were just glancing at your screen, you'd think it was a total disaster of a quarter.
Which is exactly why we're doing this deep dive.
Yeah.
Because that price action creates this huge contradiction. You actually open up the report, and what you find is a legacy bank that just posted its best core performance in 18 years.
18 years. So you're talking pre-financial crisis. That's a different era of finance.
Completely different. Fiscal year 2008. They beat revenue by nearly 20%. The engine is just roaring. But the market took it up back and punished it.
So that's our mission today then. Figure out how a bank has its best operational quarter in almost 2 decades and still gets sold off. We need to separate the signal from the noise.
And believe me, there's a lot of noise in this report. We're talking acquisitions, integration costs, and surprisingly, crypto.
All right, let's jump in. I want to start with a snapshot. I'll throw the headline numbers at you, and you tell me where things went wrong.
Let's do it.
Top line, net revenue, 551.8 billion yen. The street was looking for, 461 billion? That's a huge beat, up 10% year over year.
Right. And a double-digit revenue jump for a bank like Nomura that's significant. That's the signal we were talking about.
But then the bottom line it falls apart. GAAP EPS comes in at 30.19 yen. The estimate was over 37, a miss of almost 19%. Net income was actually down.
And that's the trigger. That is all the algorithms need to see. Missed EPS, sell. But if you're listening to this, you're looking deeper, you have to look at the quality of the earnings. And there's one metric the CFO, Marucci-san, kept coming back to.
I saw this in the transcript. ROE, return on equity. Okay, so for anyone not living inside an Excel sheet, break this down for us. Why is this the number they're clinging to?
It's a fair question. Think of return on equity as the bank's efficiency score. It tells you how much profit they squeeze out of every single yen that shareholders have invested. A low ROE means the bank is bloated or lazy. A high ROE means the machine is humming.
So it's the difference between a gas guzzler and, a high-performance engine.
Exactly. And for Japanese banks, which have historically been, let's just say, sleepy, a high ROE is a really big deal.
And where did Nomura land on that?
They hit 10.3%.
Is that actually good? Relative to their goals?
It's excellent. Their own target is a range of 8 to 10%. This is the 7th straight quarter they've been in or above that range. So management's argument is basically, hey, ignore the one-off stuff that kill EPS this quarter. Look at the efficiency of our actual business over the last 2 years.
So they're claiming this is durable. They're saying the business is just structurally better now.
That's the whole pitch, that the earnings power of the firm has fundamentally changed. And they want the market to give them credit for that consistency.
Okay, so let's test that claim. If the machine is working so well, what's the fuel? Let's get into the bull case, these core engines that are supposedly at an 18-year high. What are we talking about here?
So when they say core, they mean their 4 main businesses: wealth management, investment banking, all that stuff, and they strip out the other category. Just those core segments hit a pre-tax income of 142.9 billion yen. That's the highest since Q1 of 2008.
And looking at the breakdown, one division seems to be doing all the heavy lifting.
Oh, yeah. Wealth management? It's not even close.
I feel like we've been hearing this story for a decade. The Japanese saver is waking up. The Japanese households are sitting on mountains of cash, and one day they'll invest it. It almost feels like a fairy tale at this point. Is it actually happening?
Sure. It is finally happening. This isn't a projection anymore. This quarter, Nomura's recurring revenue assets hit an all-time high, 28.1 trillion yen. But the number that really tells the story, it's the flow.
The new money coming in the door.
Yes. Net inflows of those recurring assets topped 500 billion yen in 3 months.
That is a massive number. But why now? What finally changed to get 500 billion yen moving in 1 quarter?
Inflation. It's the one thing you just can't ignore. For decades, Japan had deflation. Holding cash under the mattress was a winning strategy. Your money was worth more every year just by sitting there.
The old cash is king mentality.
Totally. But now Japan has real persistent inflation, so that cash under the mattress is losing value. It's a melting ice cube. This is that savings to investment shift everyone's been waiting for. It's not driven by greed, it's driven by a need to preserve wealth.
And Nomura is just the bucket catching all that water.
Exactly. And this is so crucial. This isn't volatile trading revenue. These are recurring revenue assets. That means fees. Predictable, stable income.
Yeah.
It turns the bank from a casino into something more like a utility.
Which investors usually love, right?
Right.
Predictability should get you a higher stock price.
It absolutely should. And management made a point of saying that even with recent market jitters, client sentiment is holding up. People aren't doing this to get rich quick. They're doing it to protect against inflation. That's a much stickier reason to stay invested.
Okay, so wealth management is the rock. But the report shows investment banking also had a monster quarter. And those two don't usually fire on all cylinders at the same time.
No, you're right. They're usually counter-cyclical, but this time, everything just worked. Investment banking net revenue was up 31% from last quarter, best performance they've had since 2017.
Was that just the global markets rallying?
Yeah.
A rising tide lifting all boats?
That was part of it, for sure. Equities revenue was a record. But it's also about deal activity within Japan. There's a huge corporate reorganization happening. Companies are going private, spinning off divisions, merging. The push for better corporate governance in Tokyo is creating a fee bonanza for advisors, and Nomura is right in the thick of it.
Here's my concern with that, though. Everyone is talking about the Bank of Japan hiking rates. JGB yields are creeping up. Doesn't that kill M&A? Deals run on cheap debt. Is this party about to stop?
That's the logical question. And they were asked about it directly on the call. Their answer was interesting. They see, and I'm quoting here, limited impact on the deal pipeline so far. The strategic pressure on these companies to restructure is just stronger than the headwind from slightly higher rates.
Okay, let me sum up the bull case. You have a historic, once-in-a-generation shift of cash into investments driven by inflation. You have a corporate sector that's restructuring like crazy, generating fees. And the bank itself is running at a 10% ROE.
It's a very, very strong setup.
Which brings us back to the original question. If it's all so good, why is the stock down 4.6%? Let's flip to the bear case. What's the drag here?
Right. This is where it gets messy. The EPS miss comes down to two things. One was a big strategic move, and the other was, well, a bit of a self-inflicted wound.
Let's start with the strategic one, the Macquarie deal.
Correct. Nomura bought Macquarie's public asset management business in the U.S. and Europe. The deal closed December 1st. On paper, it's a great move, adds 25 trillion yen in AUM, gives them global scale.
But acquisitions come with costs, big costs.
And this is a classic case of what they call the J-curve.
Walk us through that concept, the J-curve.
Sure. Think of the letter J. When you make a big acquisition, your profits dip down at first. That's the bottom of the J. You're paying for integration, new systems, severance, all the upfront costs. Then, over time, the synergies kick in and your profits shoot up higher than where you started. That's the long stem of the J. Nomura is right at the bottom of that curve.
So this quarter, they took all the pain but didn't get the gain yet.
Pretty much. They booked about 11 billion yen in costs. But because they only owned the business for 1 month of the quarter, December, it only brought in about 7 billion yen of revenue.
So it was a net negative for the quarter.
A pretty big one. And the CFO made it clear, this isn't over. They're expecting around $100 million in total integration costs over the next 2 years.
Ugh, investors hate hearing integration costs. It just sounds like a black hole for profits.
It requires patience, and this market has zero patience. But the second factor is what I think really spooked the traditional bank investors, and that's in the other segment. Specifically, a unit called Laser Digital.
Their crypto arm.
That's the one.
I have to stop you. We're talking about Nomura. This is a 100-year-old Japanese institution. Why on earth are they reporting big losses on crypto trading?
That is the multi-billion yen question, isn't it? Laser Digital is their digital asset subsidiary, and the CFO had to explain that this tiny unit was a major drag on the entire company's earnings because of what happened in October and November.
Which were very volatile months for crypto. But shouldn't a bank just be making fees from clients? Why are they taking directional bets themselves?
You would think so. But it seems they were holding inventory, they had long positions that moved against them. They also got dinged on some currency hedges tied to those assets. The CFO basically admitted that crypto earnings are volatile by nature.
Yeah, it might be the understatement of the year. It just seems like such a culture clash. You've got one division trying to convince grandma to buy a safe mutual fund, and then down the hall there's a crypto desk lighting money on fire.
It's a completely valid criticism. It's a huge red flag for the kind of investor who typically buys a Japanese bank stock. You buy Nomura for stability and a dividend, not for crypto beta. If you wanted that, you'd just buy Bitcoin, not a bank.
Did they say how they're going to fix it? Or is this just the new reality?
They said they have tightened control over positions and risk exposure. Translation. They're putting a much shorter leash on that desk. But the damage for this quarter was already done.
So the market sees this great core business, but it's being weighed down by messy acquisition costs on one side and a crypto casino on the other.
That's it exactly. They're pricing in the mess and completely ignoring the engine.
Okay, let's look forward a bit. Investor context. Management isn't just taking this lying down. They announced a buyback.
And it's a pretty big one, up to 60 billion yen, or 100 million shares. It starts on February 17th and runs through September.
That's got to put a bit of a floor under the stock price, doesn't it?
It certainly helps. It's a signal that management thinks the stock is cheap. And, importantly, they can afford it. Their capital position is rock solid. Their Tier 1 capital ratio is at 12.8%.
And for anyone who doesn't know, Tier 1 is basically the bank's emergency fund.
Right. It's the core capital they have to absorb any unexpected losses. 12.8% is very, very healthy, even after paying for the Macquarie deal. The balance sheet is a fortress. They're not in any trouble. They just had a complicated quarter.
So what's the catalyst then? What actually makes the stock re-rate higher from here?
It's a show-me story now. They have to prove two things. One, that the Macquarie costs are under control, no more negative surprises. And two, and this is the big one, they have to get the crypto volatility to zero.
Stop the bleeding from Laser Digital.
Exactly.
Yeah.
If they can post just one clean quarter where that 10% ROE from the core business shines through without any buts or excepts, the market will have to pay attention. But until they do, skepticism is going to rule.
Okay, I think I get it. The underlying business is great, but the headline numbers were ugly. Which brings us to my favorite part of the show.
I'm always a little nervous when you say that.
It is time for our This Is Not Financial Advice segment.
And here's the disclaimer. We are just two voices on the internet. We don't know you. We don't know your risk tolerance. Please do not trade based on this. It is for entertainment and educational purposes only.
All right, I've been looking at the split personality in Nomura. The good bank versus the bad bank.
Yeah.
And I think there's a trade. I'm calling it the samurai mattress arbitrage.
The samurai mattress arbitrage. Okay, you have my attention.
So the logic is this. We've established the savings to investment shift is real. 500 billion yen is flowing out from under mattresses and into Nomura's wealth products. That's a long-term tailwind you want to own.
Agreed. That's the high-quality, stable part of the business.
But the stock is cheap because of what I'm calling the crypto discount. The market is scared that Laser Digital is going to blow up earnings again next quarter.
Right, the unpredictable part.
So here's the trade. You go long Nomura, you get the buyback support, you get the wealth management boom, you get the cheap valuation.
Okay, simple enough. But what do you do about the crypto risk?
You hedge it out. You go short a basket of pure play crypto miners or maybe a high beta crypto ETF.
Huh. That is surprisingly clever.
Think about it. You are synthetically isolating the boring, profitable Japanese wealth management business. If crypto crashes, your short position makes money, which should offset whatever damage Laser Digital does to Nomura's earnings. If crypto goes to the moon, well, your Nomura stock probably goes up anyway because their other segment has a great quarter.
So you're basically hedging out the volatile venture capitalist that's living in the bank's basement. So you can get clean exposure to the prudent wealth manager on the main floor.
Exactly. It's a laser-guided value play. You strip out the noise that ruined this quarter's report, and you're left with just the signal.
I have to admit, it's not the craziest idea I've ever heard. It directly targets the exact frustration that investors have right now. You're creating the good bank yourself because management hasn't spun it off.
I will take that as a glowing endorsement.
Take it as an it's interesting. I'll give you that.
All right, let's wrap this up. What's the final thought for our listeners today?
The key word is durability. Management used it over and over on the call. They are making a bet that their new, higher level of profitability is durable. The revenue beat and the fund flows, they support that story.
But the EPS miss and the crypto losses just scream unpredictable.
And that's the gap they have to close. They need one clean quarter, no excuses, no one-off acquisition costs, no crypto mishaps, just clean execution. If they deliver that next time, this stock is going to look very different.
And with that 60 billion yen buyback starting soon, They're putting their money where their mouth is. We'll be watching to see if they're right.
We will indeed.
Keep your eyes on the tape. We'll talk to you next quarter.